How would you like to make more profits consistently trading futures? And in this video, I want to break down a few setups that I've taken, and I want to go over the difference is if we traded futures versus if we traded options. I'm going to go over my entries, my stop losses, my reason for entering, and I'm going to compare the difference with a live replay of the exact setup comparing futures versus comparing options. And then I'm going to talk about when it's better to play one or the other. Before we get into it, I'm going to post a link in the description below for my Instagram at Ameritrade. I definitely recommend everybody to follow me on here. I post daily trading recaps along with very good trading tips and tricks that I guarantee you're not going to find anywhere else on the internet. You're missing out if you're not following me on my Instagram. But now let's get right into this video. A couple key points I want to explain first is I still trade options. I love options. There are times we should trade options, specifically depending on the conditions in the market. So I still trade them. I still love them. The point of this video is I want to compare and contrast if we took the same trade with futures and the same trade with options, how we can make more money, what we make more money on, and how stress-free the type of setup we could take, along with other external factors that are going to influence our decisions for the setups. In fact, recently I did a full in-depth futures versus options video. I'll post a link for that also in the description below. To gain context for this setup, let's go over the pre-market plan in my Discord. I post whatever I'm watching, levels I'm looking out for, and potential trading scenarios. So on the S&P 500 last week, scenario number 2 was a bearish plan that if we get below and remain below this 3856 area of supply, this pink box, then we are going to test 3794, which is this green box over here. If this level breaks and we break the previous day low right over here, then I expect a test of demand at 3776. And that was our bearish plan, basically a short below the green box, targeting the demand zone even lower than that. So now the market opens up. We're putting in lower lows intraday. We're also putting in lower highs. This formulated an intraday supply zone that as we rallied into this, it failed and the market started moving lower. Now beforehand, we did break below this 3794 level, but I did not see valid confirmation to take the market short. In fact, at this 3794 level, specifically because we did break the previous day low, there were a lot of tracked retail shorts indicating a potential market reversal to the upside. We got that reversal, rejected right at this intraday supply zone, and then the market started moving lower. Now at this point, as we move down, this is where I posted my update in the Discord where I was watching this 3794 level again. If we can break below this with strong selling, I am open for scalping short, targeting 3776 demand, which is this green line down here. Now at 12:38 Eastern time, I opened up a ES, which is the E-mini S&P 500 futures contract. I opened up a short position at 12:38 Eastern time. And my risk to reward for this setup, making $5,400, was about a 2.5 to 1 planned risk to reward. And this is what the chart looked like at the time of entry at 12:38. One thing I would like to note is that the market was very balanced. We were very choppy and we were in a very tight range, where trading options in such balanced conditions, in my opinion, is not favorable, as options are priced not only by time, but also by volatility. So when the market is balanced, we see buyers and sellers agreeing on price. We don't really see one side taking over and having an edge over the other. So this position was, I was getting in short in speculation that sellers were going to step in, break below 3794, as that was what the plan was, targeting the level below. Now, we don't know if volatility is going to come into the market. However, if we look from right to left and see the conditions on the chart, on an intraday perspective, yes, we're putting in lower lows. Yes, we're putting in lower highs, but we're lacking volatility, we're lacking momentum, and we are balanced on an intraday perspective in the first 3 hours of the market open. So now what we have here is the S&P 500 chart on the left, and on the top right active trader, we have the S&P 500 futures contracts on the top right. My fill on the futures, which is the trade that I actually took, was around 3797, and my stop loss was above 3806. So I was risking about 9 points to make about 21 points on this setup. And now here's the options chain for those who do trade options. Again, these conditions are not really favorable in my opinion for options. I'm going to show you the best conditions to trade them in. So I would favor trading futures in this. In fact, I would say 95% of my trades in the current market conditions have been futures contracts. However, here are the options. What I'm going to do is I'm going to pull up at the money SPY puts, paste them into this active trader, and now we have the SPY puts at the money down here. I'm going to replay this simulator, and at the same time, I'm going to sell the S&P 500 short on the futures contracts around 3798, and I'm going to buy 55 put options. I'm going to long puts. When I'm longing puts, I'm expecting the market to go down around 98 cents. So these two trades, depending on your broker, would have cost the same amount of money depending on the margin of your broker. So now I'm in short the futures contracts and I'm long the puts at the same time when the market looks like this and we're about to sell off below 3794. Now here's where it gets very interesting. The yellow oval is where we got short the future contracts and long the puts. At the time of entry, now it's about 20 minutes later and the S&P 500 is at the same price, about the same price where we got short the futures and long the puts at. If we were to look at the futures contracts where we got short 5 contracts, we're actually technically up $60 on this position. However, if we were to look at the option contracts, we're technically down $500 on this position, which is about a 10% drawdown in a 20-minute period. Yet the S&P 500 chart has not went anywhere. We barely went down, we barely went up. The contracts are about break even, which is why I'm up only $60 on the futures, yet the options are now down $500 because of the lack of volatility and the lack of direction where we're still trading in the same range. So you could totally tell right off the bat, just 20 minutes, that trading futures become favorable because there's less stress and less other external factors that we have to worry about. If we're trading futures, we don't really care so much if the market is sideways or it's lacking volatility. Whereas options, we know our premiums are going to deteriorate and lose a ton of value if we are not correct, not only on the direction, but also on time. Whereas if we are trading futures, the only thing we care about is direction. Our stop loss is in place, our target is in place, and we're going to know exactly how much we're going to lose if we're wrong, and we're going to know exactly how much we're going to win if we are right. We could not have guessed that we would have been down $550 right now, even though the S&P 500 is at about the same price that we got short at. So the problem here is that a very emotional trader, or especially a beginner trader that sees their P&L down $550 in a 10-minute period, or their position down 15-20% in a short amount of time, what they're going to do is even though their analysis has not proved them incorrect just yet, this chart is not really proving themselves to be wrong just yet, right? The market's not going to move in our favor perfectly, exactly how we planned it out to be and how we want to see it. So you're going to have roadblocks. This rally up does not prove our analysis incorrect. However, trading options, we are technically down 15% or 12% on this position just because we chose to trade options, whereas the futures are about break even. This uncertainty factor with how much we're going to lose if we're wrong or where the chart is going and compared to how our analysis is doing, this factor of the uncertain outcome is going to affect our decision-making process. And I've seen a lot of traders get out of a position where their analysis is still correct. However, they have to get out of it because they cannot afford to lose anymore because the options are deteriorating. So in my opinion, right now with the current market conditions, trading futures especially for a beginner trader is easier to do than options unless you are scalping quick little 1, 2 minute, 3 minute type of trades. Now here's where it gets a little sticky. Now the S&P sold off. We're down about 6-7 points from where we entered short at. The option contracts are now up about 20%, and they're about a little less value compared to the futures. So right now, if we traded futures, we're making a little more money compared to what we would have if we traded the options. However, we were in this stressful little 30-minute period right here where the market lacked momentum and it lacked a clear move. Whereas the futures, we were barely ever red and we barely stressed because we did not have these external factors. So now what you're going to see here is the market is going to dump very violently, very volatile, and it's going to have a lot of momentum. The option contracts, see that dump right there? The option contracts are going to explode when we get this type of volatility and the volume building up into the market. Whereas the futures, it doesn't matter. Yeah, we're going to get a quick price swing. The futures are going to go up in value very fast. However, since we get a lot of volatility and probably a lot of people opening up puts, the value of the option puts are going to increase significantly. When we see this volatility, it's vital if you are trading options to scale out or sell your position when the volatility increases in this such of a manner. The reason for that is the puts right now, you're making about $2,500 profit on a $5,000 investment, a 50% return in about 35 minutes now. The problem is if we do not take profit off the table right now and the market does start moving up, now our contracts were only up $1,100 on those puts, and we just lost 25% of those gains because we did not take profit on that quick little volatile dump to the downside. Now the market's not moving in our favor and our puts deteriorate, where now we're only up about $700 because of that reversal. So when you see volatility like this and you are trading options, it's vital for you to take profits off the table to protect yourself, especially when looking at the conditions and they are very balanced, lacking follow through and lacking momentum. The futures are still up $1,000 right now, and the options are now only up $700. So that little choppy action, lacking follow through, if you are trading options, it's going to get in your head, it's going to frustrate you, and it's going to make you make emotional decisions. And I've seen very talented traders with excellent analysis having to get out of the position because of these external factors influencing how their position has to be managed. With futures, this is not so much of an issue, and futures are a consistent, accurate price action, whereas maybe one trade, we get a clean options trade. And the next options trade, we get a really choppy one. And the one after that, we get a really choppy one. Whereas the futures are always going to be consistent, raw, organic price action, where you don't have to have it in the back of your mind, all these external factors. And now the S&P 500 dumps down. We hit our 3776 target, and I made about $5,400 profit on this trade, trading the futures contracts. If I traded the option contracts, these options are about $7,200 in profit. So yeah, it's about a $1,800 difference. However, trading the futures are much more consistent price action, where you do not have to have something in the back of your head worrying about external factors, where your position is going to lose a lot of its value even though your analysis is correct. In the comments, let me know how many of you had a really good analysis, but because you traded options, maybe it was choppy, maybe we were moving sideways, it stopped you out of that position because you hit your max loss or you hit your monetary stop loss, which is not good to trade off of. But how many have exited a trade prematurely because you traded the options? Whereas watching this, if you traded the futures, it would have enabled you to stay in that setup and make money on a consistent basis. This is a setup where I'm proving the point on both sides of the argument. I could show you 100 different trades that I took where trading futures was the best move possible and trading options would have made me lose money. Like I said from the beginning of this video, I still trade options, and the best time to trade options is when there is clear direction and when there is volatility. You see this volume coming into the market right here. You see these large price moves with clear direction in the market. This is when options are the better instrument to trade. You cannot argue the fact of the percent gain returns with options. You cannot get them with futures. You cannot get them with stocks. You cannot get them with any other instrument other than options. So when we see action like this with very large price swings, volatile movements with momentum, trading options is the way to go. You have to ask yourself, do we get that action on a consistent daily basis? And if you don't, then try trading out futures. Let me know how it goes. It is more consistent on the price action. If you can't figure out these volatile little moves, for example, this would have been excellent if you could have traded options, but it was when the market was closed. So futures, we could trade this move, while options, we cannot trade this move. However, if this was intraday when the market was open, this volatile, sharp movement like this would have exploded the option premiums. You cannot get those percent returns with futures. However, the whole idea with trading is repeating your process on a daily basis. Can I repeat what I did today, tomorrow? Can I repeat it next week? Can I repeat it next month? And trading futures enables you to repeat that process day after day. I also did a live trading video. I'll post a link for that one in the description below as well. You could see exactly when I entered, when I exited, and my overall thoughts as I was in the setup. I recorded it live like you were sitting next to me. I traded futures on this setup last week. And if I entered with the option contracts where I did with the futures, I would have been stuck in about a 30-minute period of chop where my premiums would have been down 10%, 20%, maybe up 5%, up 10%, and it would have messed with my emotions, and I had no control over the instrument, although I had control over my analysis where this thing did work out and I didn't have to worry about those factors with futures. Then the market pulled back. I got in over here at this green arrow, came up over here where I got out of this position, but let's just say I was still in it and the market pulled back. If I didn't take profits up here at my red arrow, this pullback would have made me down probably 30, 40, 50% on this position, even though at one point I was probably up 20, 30%. So the wild price fluctuations of your position are going to be existent with options because of these external factors like the Greeks. So that was a little visual exercise. I hope it helped you see it and compare and contrast the two futures versus options for each setup. Test it out yourself. You could go to the options chain, look at the premiums, copy the chart, and then paste it in one of your setups. Watch the other videos in my channel and definitely check out the links in the description below. I just added a full futures trading section to the A to Z course. The prices on the website will remain the current prices until after Black Friday, and I'll be raising them back up to the original price. But I'm going to end the video on that note. I hope you enjoyed. Peace out.